So as I was saying, the calculator functions in this way. If it's simple interest rate, a 10% every month would be £1,000, which is your principal, times 1.1. Your total value would go to 1,100, and the next month would would go to 1,200. But this is not simple interest rate; it's compound interest rate. So that basically means that the 1.1 in the following month would be multiplied by 1,100. So it's 1,100 times 1.1, and you see, instead of being 1,200, it would be 1,210. And then in the next month, again, on top of 1,210, it will be 1,331 rather than 1,300. And you get the gist of that. So basically, it's a compound, so it keeps becoming a snowball, really. So that is the danger with compound, and that's why those monthly interest rates rack up to such a big amounts on an annual basis. Okay, so moving on. After you've focused on how you can earn more, how you can cut back on your fixed biggest expenses, you move on to naturally to the next level, which is the daily savings. So what if you choose to take a squeezy or a stainless steel bottle instead of buying a water bottle every day? So a plastic one. So savings per chart is that in one day you save $1. That is the price of the plastic bottle. Per week is $5 because we're talking about every day, every weekday in your job. Per month, $20, and then per year, $240. It racks up. And then another purchase saving that we can think about is, okay, let's say you want an iPhone X. The iPhone X is $850 unlocked. But then if you pay it on a monthly basis to one of those telecom companies such as Verizon, AT&T, Sprint, Vodafone, they usually offer you monthly basic payments, so you are locked to them. But the issue is that had you bought the phone directly upfront unlocked, you would have saved $100, $50, $400. So you always need to compare and put on the spreadsheets to see what's right for you. Other examples of how small changes make a big difference. So 3 examples on the blue rows. So the average spending with entertainment in 1 week for you, let's say this $50. You were still starting out in life, but let's say that instead of going out 4 times per month, you go out 3 times per month. So you cut back on 1. That will make your monthly savings on going out $50 more. Let's say as well that you actually you drink, let's say you drink a beer a day. Beer from the supermarket, let's say it's $1, just for ease of shop, but maybe it's probably more than that. Let's say it was $1. So instead of drinking 1 beer per day, that would be 7 beers per week. You cut back. You say you're only gonna drink that beer on Friday, Saturday, and Sunday. So you're gonna reduce 4 beers per week, right? So that would be $4 per week, but $16 in a month. Let's also say that you go out to just in restaurant, let's say 4 times in a month. But let's say that now you're committed to saving, so you can actually go 1 time less, so you're from 4 to 3 times per month, and the price of the food that you pay there is $30. So the monthly savings for not having 1 dinner out would be $30. With those 3 things, so going out in 1 entertainment night, let's say to the cinema 1 time less, $50 per month. Drinking 4 beer less per week would be $16, and then reducing the dinners out by one time, but from 4 to 3, so by one time per month, that would be $30. So those three things would save you $96 in a month. However, when you think about the year, would be $1,152. So small changes that make a big difference. And let's say that you pick up that $1,152, and let's say that you put in an index fund that is returning well, so it's returning 12% per year. So this table really shows you what that money can become. In 5 years, that money can become $6,700. In 10 years, $18,530. In 15 years, $39,367. In 20 years, $76,000. In 30 years, $254,843. I'm talking about this money, 1,152 out of savings in 1 year becoming $254,000. That's crazy, right? But hey, it can happen. It's compound interest. That's the thing. So the old rule is that first I spend and then I save what's left. The new rule's got to be set up what you need first. Pay yourself first, and then you spend what's left. And most people don't realize this, is that money that you don't spend going to the cinema today is worth a lot more in the future. Obviously, you need to have a balance there, because you only live once, life's short, so you need to understand that you're never going to get that time back. But at the same time, those small expenses, they rack up in the long term because of compound interest of opportunity cost that you would have gotten if you were investing that money. So what should I do to earn my first million? So I think first thing is that the key to become rich is knowing how to save and then knowing how to invest. But also thinking about, it's more important for you to actually understand and acquire the knowledge than to earning the money itself. The chances of winning the lottery are 1 in 50 million. However, studies have shown that 25% of these people who win the lottery lose all the money with time due to lack of planning, due to lack of knowledge. So it's not only enough earning the money, it's more important keeping it and then growing. Which brings to the second step to invest. You need to know how to invest your money. And for each kind of person, there's a different type of investment that actually matches your profile. And we built 3 profiles here, compound improvement. So the first one, left-hand side, is conservative investor. So that is the kind of investor that is accurate, doesn't like to lose, is old-fashioned, is protector, always wants to be in control. Then in the middle side is the moderate, so has limited time, doesn't like risk, prefers investments with fixed time and guaranteed return. And then last but not least, the bold. So is radical, exciting, loves change. He believes that the higher the risk, the better the returns can be. So it basically moves from being more risk averse on the conservative side to more of a risk lover on the both side. I think the important thing here is that nobody perfectly matches those profiles ever, but he's kind of trying to understand where you're at in that range, in that blend. And then based on that, identify the type of investments that fit perfectly with your profile. So the first guy, the conservative, would move towards Treasury Bills and public bonds. The moderate would move towards assets with limited risk, such as corporate bonds, index funds, public funds. And then last but not least, the bold will move towards variable returns, such as stock picking, trying to find the winner, leverage options, real estate, private equity, commodities, alternatives such as arts and collections. But the common theme of all is that you need to diversify. And the more you diversify, the higher the chance you're going to get good results, because nobody can predict the future. Nobody has a crystal ball. So the way that you get good returns, reducing your risks the holy grail is the triple rule is diversification. So let's just talk about a bit of those different type of investments, just as a summary. So the Treasury Bills, so its purpose is to raise funds for the financing of the public debt of the United States, but each country has their own bill, and then it has very low interest rate because it does have very low risks too. So for instance, the US government has never defaulted on its debt, so therefore it's always paid the Treasury bills as agreed. So liquidity is guaranteed by the national bank of the country of issue. And investments, as I've said before, they start from $50 and they are negotiated directly with your home broker. Corporate bonds has a different purpose. It is to raise funds for the financing of private debt of a company. It has medium low interest rate and arguably low risks. The liquidity is guaranteed up to a certain amount by finance insurance institutions such as IAG. So if the company goes into bankruptcy, they usually have insurance such as AIG. If AIG goes into bankruptcy, then you lose your money, or it's renegotiated. So the risks are relatively small, but it does happen of the event that you don't get all of your money back or all of the returns that you would be expecting. Investments are sold from $1,000, and again, the negotiation is directly by a home broker. I think the important thing here to understand as well is that bonds are senior investments to stocks, meaning that if a company goes bankrupt, let's say a bank, first, that bank will liquidate its current assets to pay the bondholders, and then after it's paid all of its bondholders, then it will pay its stockholders. So the bonds have a lower risk than stocks because they will have a senior ability to liquidate the company's debt. Moving on to stocks, I think the most asked question on stocks is why would a company sell a piece of its assets? Because when you buy a stock, you become a shareholder in that company. You own a little piece of that company. Well, there are multiple reasons, but the most common ones is because the company wants to upgrade, wants to upscale, wants to employ more people, wants to reform and restructure. Basically, it needs capital. But the company could just go to a bank and borrow money. But why wouldn't they do that? Well, because they know that the bank will charge the highest interest rates in the market. So therefore, they sell a bit of their assets with the promise that they will share their profits in the future. But then what that transmits to the company is a lower interest rate to pay versus a bank. And that's why they issue stocks. So when you buy stocks, you become a company shareholder and therefore a partner. I think you and I know that, but what does that mean? That means that by holding shares, you can earn a profit through two different ways. So the first one is that you can earn a profit via dividends. So that means a share of the profit is shared between all the shareholders on usually on a quarterly basis, but some companies on an annual basis. So let's say that I work for Mondelez, and then this year Mondelez has had a return, so a profit of 2% on the market value, which they're going to share via dividends. So every shareholder would get 2% of the total amount that they have in that company. And then the second way to earn a profit is if a company is doing well and has a bright future, more people will buy its share, and thus its share price rises. It's supply and demand. So more people want something, the price will go up. Less people want something, the price will go down. But there are many things that actually contribute to appreciation or depreciation of the stock prices related to my second point. So there's the market performance of the company, such as cash flow, revenue and costs, new projects, and debt. But not only that, there are external forces too, such as the economic impact. And that consists of currency rates of a country, foreign investment, interest rates, inflation, GDP growth, as well as employability rates or employment rates. And equally, Political impact. So what's going on in the fiscal policy? So for instance, Trump not quite recently reduced the corporate tax in the US from 40% to 17%, and that creates a massive boost to the stock market. Votes, who is getting elected, who is not. Is this more business pro policies, or actually more employee pro? New laws, political scandals, all of those impact the stock market. And then finally, what I've already alluded to, supply and demand, the law of economics. If there are a lot of people trying to sell umbrellas, the price of umbrellas will go down. If there are a lot of people, but conversely, if it's no longer a sunny day, it actually starts raining, more people demand and want to buy umbrellas, so therefore the price of umbrellas will go up. But even with all these factors that affect the stock prices, in the long term, stock prices have shown to be the most prominent investment assets. So since the new recorded history, so since 1870s, when they start recording the US stocks, for instance, on average, as a real average return of US stocks, you can see about 7%, and that is much higher than bonds or private debt that you can find out there. So therefore, for most people, stocks are in the long term the best investment out there. However, notice that I use the word long term. Why? Because the stock market is very volatile. So let's say that you don't have that rainy day cash reserve that we talked about. If you don't have it and you're forced to liquidate your investments, you may commit the cardinal sin of investing, which is buy high, sell low. You should not be doing that at any point. The whole point of investment is buying low to sell high. Basically, would you go to a supermarket and buy less when something is in promotion? No, you wouldn't do that. If you see something 30%, 40%, 50% off, you would buy more. That's the same thing that you should apply on stocks. If a stock is down, is in discount, and therefore you should be buying more rather than less. I just want to give you a snapshot of Amazon. So, for instance, Amazon is going quite up in 2010 as well, but a golden period of Amazon too was from 2010 to 2017, and the return of that stock was 1,397%. So basically, in 7 years, that the money that you had put in on Amazon would have been multiplied by 14 factor. So let's say you had put 1,000 Amazon. 7 years, that 1,000 would be transforming into 14,000. How do you get the Amazons? How do you get the Walmarts? Those are the big stocks that really get value massively, the winners. How do you choose them? Is the big question. I think the first thing to notice is that most average investors cannot pick those winning stocks one by one, and therefore index funds are probably the most appropriate investment tool. In fact, a study has been done by Long-Term Capital and Fidelity, and they figure out that 96% of investors do not beat the index funds. So there are only 4% of investors who beat index funds in a certain year. However, they are very unlikely to keep beating the index in a 10-year timeline. In fact, the winners of today are often the losers of tomorrow. So if you're not willing to dedicate a lot of time, energy, and money into investment, you're much better off just putting your money into an index fund, automating that contribution from your salary on a monthly basis, and leaving it there until your retirement or until you need the money for something. So there are two ways of choosing a stock. that I still want to go through in this course. So the first one is the fundamental analysis. So this is pretty much the one that Warren Buffett uses, or Howard Marks, or even Ray Dalio. So the greatest investors of all time, they use the fundamental analysis pretty much, and it consists of making a thorough analysis of how the company functions. So that basically means the balance analysis, the accountability analysis, the leadership team, how much the leadership team is getting paid, what's their compensation structure, is that they receive stock options and therefore they incentivized to bring great results to the company, or do they just receive stashes of cash and don't care that much about the results? How does the compensation look like versus the company's competitors? How is the sector and the market doing? What's the power of brand? So, for instance, Coca-Cola has been around for over 100 years, so therefore the brand power is massive. And at the same time, it also has marvelous future projects. It's trying to expand to the countries that are getting the highest growth rates in the world right now, which is Africa. So what does do the future projects of the company look attractive, or is it just a cash cow? Secondly is the technical analysis. That's the one that gets a lot of press because it looks very impressive. Basically, it's based on historical figures and mathematical models, and it tries to predict the future share via the price behaviors of the past. Specifically, it's trying to time when to buy and when to sell, and it uses tendencies such as supply and demand. So whenever you hear the expression trader, they're using technical analysis to make their trades. So, and then in technical analysis, they refer a lot about bullish versus bearish behavior. So what is that? So when the market is going up, it's called bullish because the bull attacks from down up, so doing that movement. And when the market is going down, it's called bearish because the bear attacks from up down. So that's what it is. And then one of the main tools that they use is supporting lines. What that basically means is via historical figures, they see that, for instance, in the last time that a stock went down, it just went down up to a certain point. So here you have an example of, so the first example is actually went up down to that point here in 2016, the stock, 2006 in the stock, and then when stock continued to go up, but then when it hit that same support line, that same point in 2008, that was a very important historical point. So the company would have to be in very bad situation to actually continue to go down. So it's a very strong point that shows that the stock should be going up, because on a historical basis, it would be a first time that a company went as bad as it could. And then again, another support line was created later on over here, which when the stock price hit that point again, it was very likely that would go up from that point on rather than going down. But this is not set in stone, it's not black and white. All can happen. Nobody can predict the stock market. It could have continued to go down. It's just a strong indicator that is reaching the cheapest point that is being in some years. So that's how you should interpret spotting support lines. And a lot of people also use those things together. Fundamental analysis to check a long term whether a stock and a company are worthy of their investment, and then the technical analysis just to spot the right time to get into the position. Again, something that I've mentioned before is diversification. It's really important. But a lot of people, they ask, can you give me a rule of thumb on how much money to put in stocks? Basically, and this should help people to understand how important it is to be in stocks in the long term. Because in the long term, stocks will always be good. But there are points in time, so for instance, in 1930s or 1970s, where stocks were down for 10 years straight. In the long term, if you put your money in stocks for 10 years, you wouldn't have a good return. But in 20 years, you would then revert into a good return. In 30 years, an excellent return. In 40 years, an amazing return. But let's say that you are 80 years old right now. Well, statistically, you're probably not going to live another 40. So therefore, you should apply a lower percentage of your income, of your net income, into stocks. And the rule of thumb that people have is that you get the number 80 minus your current age. It gives you the maximum percentage you should apply on stocks. So let's say John is 60 years old. You get the number 80 minus 60. 20% would be the maximum percent that he should be applying in stocks. The other 80% should go to more conservative methods such as bonds or Treasury Bills. So again, a reminder that it's important to invest in stocks without compromising your personal finance and having the cash reserve for a rainy day. And that's all for today.